Friends, good day. I dedicate this video to systematic options trading. I'm often asked by other traders how to trade options to get a stable income. I will tell you about the way of trading with predictable risks and with managing these risks. I know about systemic trading firsthand. I have been using this way of trading for more than 10 years. In 2013, I developed a training course on systematic option trading. It was quite popular, and in 2021 I started to update my training course. I have re-recorded the basic course of options trading, effective volatility trading, and now I'm updating the chapter on systematic option trading in this video just for you. If you have an interest in a similar, more detailed training course, leave a comment below. First, what strategies are suitable for systematic option trading with constant and stable income? Selling options is about generating fixed income through time decay. The time decay premium is predictable, and the one thing we know for sure is that at expiration the time premium will be zero. The main question is whether the option will be in the money at the time of expiration or not. And the strategies that are commonly used are strangles. Suitable for us are 2-week or monthly series. For one example, I'm going to choose put options of Strike 41. I sell 1,000 of these contracts and I get the following chart. And now I'll choose call options with the same delta. For example, Strike 48. We end up with a strangle. This is a very popular option strategy. In a classic volatility sell strategy, we use delta hedging. However, for the purpose of systematic option trading, if we realize that the price will remain in the range between 41,000 and 48,000 until the end of January, this example is, of course, far from the best, but anyway, I just choose these numbers as an example to explain the technology. If the price stays in this range, we will get this profit cap. The profit will be almost $2,000. But the margin requirements are $7,433. If we use the maximum of our trading account, which we shouldn't, the potential profit is 35% of GM. For systematic option trading, you cannot use 100% of your trading account at all. Therefore, you should only use 20 to 30% of your trading account at the beginning. If we want to get $2,000 for a period of less than a month, we need to consider the following. Of course, the price of the asset will change. Bitcoin will not stand still, but if we sold at a good volatility, we will get a good profit. Systemic trading is a valid method because option selling strategies are built on the fact that options are generally overvalued. It is statistically proven that 80% of the time, options are slightly overvalued in volatility compared to the volatility of the asset. This is perfectly normal because the risk from the sales should be covered by an appropriate premium. Sellers should get their margin, but hedgers, as a rule, should overpay a bit when buying options. It's like an insurance. No insurance company will sell insurance at a loss for themselves. In order for an insurance company not to go broke, they have to put a profit margin on their sales. It's the same with selling options. In order for the seller to make a profit, he makes a small markup of his own profit. Therefore, the options turn out to be overvalued. And now what happens if the price of the asset changes in a systematic option trading strategy? We must make a trading plan in advance in which we determine our course of actions if the price of the asset falls or rises. If the price falls and crosses the break-even point of 41,000, we apply a roll to the next strike, for example, 40,000. Rolling is done with a ratio, so we need a budget of an extra 10% in the trading account to secure the strategy. So we need to be prepared for our margin requirements to increase. That's why it's important to make a trading plan in advance before opening the strategy, to be ready for price movements. We should have a clear idea of how many rolls we can make. Can we make a roll when the price drops to 35,000, for example? We make the same calculations to protect ourselves against a price growth. If there are strong bullish factors, we can exclude selling call options and use only selling put options. Yes, the return will be significantly lower, but it will be there one way or another. We can sell more put options and prepare to roll if the price goes down. The return is lower, but the risks are also lower. With Salt Strangle, there is risk on both sides. But if we only sell put options, we only have risk on one side. Once again, I would like to emphasize the importance of a trading plan. We must clearly know our potential income and the measures we can take in case of an undesirable price movement, and we must reserve funds in the trading account to meet margin requirements that may increase due to rolls. If there is a rise, we should be prepared in advance to buy additional call options or additional put options if there is a fall. If the price approaches our options bought in advance, if they are bought in advance, they will be cheaper, and if the price approaches them, we just sell them for a higher price. In this way, we hedge the purchased options. But first, we have to calculate everything properly and take into account the volatility too. If volatility rises, roll on more expensive options, the ratio will decrease. On the one hand, the increase in volatility hurts us, but on the other hand, it allows us to roll with the lowest ratio. I advise you to do some modeling on your own. Make a list of possible scenarios and ways to deal with these scenarios. Selling options is a vega negative and gamma negative strategy. Falling volatility is a plus for us, as you will have to do less rolls. Another important point is not to trade against the trend. I tried trading against the trend 15 years ago, but I was able to make a profit with rolls in a tough situation. Strategies like strangles are better to roll in their entirety because if you only work on one side, the other side will bring you nothing but risks. Options will end up deep out of the money and the time decay will no longer be there. If, for example, the price rises, then by making a roll of the whole strategy, you get the additional time premium of the put options. And that's all I wanted to tell you about the possibilities of systematic trading. I advise you to build your own strategies. You can use the AE terminal for free. Do not forget about the risks. When selling volatility, the main factor is volatility growth. When volatility is growing and you have reached your margin requirements limits, close your position and cut your losses. Don't forget your trading plan and the maximum limit of your risk. If you have any questions, please ask them in the comments. Leave a like for this video so that other traders could find it. Subscribe to the channel if you haven't already done so, and I wish you all the best and successful options trading.